No matter at what stage you are, whether you're young, you are middle age, or you're close to retirement, but you're seriously looking to start your investment journey and you're looking to do a long-term investment, then this video is for you. You know what we will discuss in this video? We will discuss about one of the most popular financial instrument, which is named ETF. So stay tuned because we will discuss a lot more in this video about ETF. Like what is ETF, what are the types of ETF, why ETFs are great for investors, comparison of ETF with mutual fund, and a whole other topics. After watching this video, you will become an expert into selection of the ETF. So stay tuned. So what is an ETF? An ETF actually stands for Exchange Traded Fund. And according to Investopedia, the definition of ETF is an exchange traded fund is a type of pooled investment security that holds multiple underlying assets rather only one. Seems complicated, right? But let me break it down for you. Consider an ETF like a basket which actually holds a number of stocks. It could be 10, it could be 50, or it could be 500. So when you are looking at the basket which holds a number of stocks, there are different benefits. So let me tell you each of the benefit of ETF. So number one and the most important, it is diversification. Let's just assume hypothetically that you started your investment journey and people were saying you should buy this stock and that stock, and you listened to one of your friend and you bought any of the stock by the name of, let's say, Beta. You bought the stock, the first year stock performed really well, your portfolio value actually went up, but in the second year the company announced bankruptcy. So what happened to the stock? Stock went to zero. What happened to your portfolio value? It went to zero. And you know why it went to zero? Because you basically invested all your money into single stock. And here comes the benefit of diversification, which you get by investing into ETF. Because as I said before, ETF is like a basket which holds number of stocks. Like in the case of VOO ETF or SPY, these are the ETF that basically track a broad index like S&P 500, which is a most popular index in the stock, which contains a 500 of the most prestigious companies in the US. Now, let's just say you invested into S&P 500 ETF, either VOO or SPY, and one of the company in the ETF actually went bankrupt. So what's going to be the impact in your overall portfolio? It's going to be a very negligible. You know why? Because these ETF actually hold almost 500 companies in the ETF. And if one company goes bankrupt, it's not going to be a huge impact on your overall portfolio size. So here you see the benefit of diversification. The second benefit is the passive investment nature of the ETF. Let's just say you are looking to start your investment journey and you're reading the news, you're looking at the industry report, you're talking with the industry experts, and then based on that you start your investment into ETF. And then you have to actively overlook the position. But the good thing is when you invest into ETF, all you have to do is to invest into ETF for a long term. Then the ETF will gonna do everything. Then the ETF will gonna do everything for you. It's gonna be buying the asset in their own portfolio. It's gonna be the selling the asset and everything. All you have to do is just sit down and relax and see your portfolio value compounding over the period of time. Now the third benefit of the ETF is the cost. Cost is a very important aspect. When you are looking to invest, you have to realize that even a small percentage can be a huge difference when you are looking to invest for like a period of 15 years or 20 years. So ETFs are actually cheap as compared to mutual funds and other financial products. So keep that in mind. And the last benefit of the ETF is the liquidity, which means that the ETFs are actually traded on the financial stock exchange, which allows an investor ability to buy and sell throughout the day as the market is open. So which gives you liquidity, as you can buy or sell, and the willing investor can basically buy or sell from you, which you cannot see in the case of mutual funds or other over-the-counter products. Now, just to give you an idea about the popularity of ETF, I want to show you some of the numbers. Now, back in 2000, there were only 80 ETFs. And fast forward to 2024, the number has exploded to over 3600 ETFs. That's right, over 3600 ETFs. That is an average annual growth rate of 17%. But stay tuned, I have another interesting fact. In 2000, there were only $66 billion of ETF assets under management. And you know what is the number in 2024? A whopping $10 trillion. You heard that right. $10 trillion of assets under management are in the ETF. That is an average annual growth of 23%. Another interesting thing is about 17 million or about 13% of the US household held ETFs in 2024. And of that household that own the ETF, about 80% also own mutual funds. I believe these numbers will make you compelled to start investing and look at the ETF as a serious contender for your investment. Now, I want to discuss about the types of ETF. There are different types of ETF. The most famous one are the passive ETF. What is passive ETF? A passive ETF basically tracks the performance of broad index, as in the case of S&P 500 or Nasdaq, Russell 1000, 2000. These are the indexes, and there are a number of ETF that basically track the performance of these indices. Now, there are also another kind of ETF which we call actively managed ETF. The actively managed ETF are basically an ETF which are actively managed, which means there is a dedicated portfolio management team that basically takes investment decision, which stock to buy, which stock to sold in the actively managed ETF. Well, actively managed ETF are actually quite expensive as compared to the passive ETF. Now, then we have a sector ETF. Let's just say you are interested to invest into AI, robotics. You are interested to invest into healthcare. You are interested to invest into utilities infrastructure or any of the different sectors. The good thing is there are different sector-wise ETF which will give you exposure to that sector performance. So if you are interested to invest into, let's say, AI, you can consider investment into BOTZ ETF. Let's just say if you're also interested into invest into healthcare, there's another ETF by the name of XLV. So you can get the idea that you can basically invest into sector specialist ETF. Then you have commodity ETFs, which will basically give you exposure to the commodities such as gold, silver, crude oil. Then you also have bonds ETF. These ETFs are actually quite good if you're looking for regular income, because as you know, bonds are the fixed income instrument as they pay a regular income. Now, there is a whole exhaustive list of the ETF, but these are the few which are most famous in the types of ETF. Now I want to share about what is the difference between the ETFs and the mutual fund. Now, as you can see on the screen, the ETFs are the financial instrument that can be traded on the stock exchange, while mutual funds are actually not traded. You can buy or sell the ETF throughout the day when the market is open, but mutual fund you can only buy or sell at the end of trading day from a mutual fund firm. The good thing about the ETF is liquidity. It gives you a high liquidity, as you can buy or sell throughout the day at the stock exchange, but that's not the case in the mutual fund. When we compare the cost of the ETF versus the mutual fund, we will see that the expense ratio of the ETF is quite low, while mutual funds are quite expensive. Now, another good thing is there is a no minimum investment into ETF. You can buy as low as one share of ETF, but there is a higher minimum investment amount in the mutual fund. These are the most important differences between the ETF and the mutual fund. Now, after discussing fundamental concepts of the ETF, we should look at which ETF should we select for the investment. But wait, as I said, there are over 3600 ETF in the market. So how should I select the ETF which I believe are good for me? So for that, you basically have to create your own investment goal, your own investment criteria, and based on that, you basically filter out which ETFs are best for your position. Now, let's just say if you're young, you have a 20-30 years down the road before you retire. So you can go into ETF which give you a more growth exposure. But on the other hand, if you're close to retirement, you're looking for more security, more stability. You are looking for something which gives you a regular income. So in that case, you have to invest into ETF which are defensive, which are stable, which offer a higher dividend yield. So there's no one rule for everyone. Rather, you have to look at your own circumstances. Based on that, you basically make an investment decision and then you select the ETF on that investment decision. If you want to learn more, you can DM me and we will discuss one-to-one. Now, I want to share about how to basically analyze an ETF. When you look at the different ETFs, you will basically look at their website, and then on their website you can look at each of the ETF fact sheet. A fact sheet is something which will basically give you the information about the ETF. And what are the important things that you have to read in the ETF fact sheet? Let me break it down for you. Number one is the ETF strategy. The ETF strategy section in the ETF fact sheet will basically tell you what is the strategy of that ETF. And from this section you can see whether or not this strategy that is being mentioned in the fact sheet actually aligns with your investment goal. If it is, then you can consider investment into this ETF. Otherwise, you can look at the other ETF. Now the second aspect is the cost. As I said before, cost is a very important aspect when you're looking to invest into financial instruments. So you have to look at what is the cost, and you have to compare the cost with the other ETF, and then based on that you take a decision. The third thing you have to look is the holdings of stocks and the sector exposure. Now let's just say you are looking to invest into passive ETF which give you a broad exposure to S&P 500 index, and you are reading the different ETFs fact sheet. One of the fact sheet that you read is basically says it gives you the exposure to S&P 500, but when you look at the holdings of the stocks and the sector, you see there's been a difference, right? So that means their strategy is slightly different as compared to the S&P 500. So this is also a very crucial point that you have to analyze when you're looking at the fact sheet. Now, you also have to look at the performance history of the ETF. While the past performance is not going to guarantee the future performance, but it will give you a good indication how this ETF has actually performed. And longer the track record, like 15 years or 20 years and more, the longer you can see how it has actually performed during the period of time, which gives you a pretty good idea about the performance and the risk and returns of the ETF. Now the last section that we have to look is the assets under management of the ETF. Well, as a general rule, higher the ETF assets under management, higher is going to be the liquidity, and lower the ETF AUMs, lower is going to be the liquidity. What do I mean by the liquidity? Liquidity means the ability to easily buy or sell the ETF by incurring as low cost as possible. When the liquidity is high, the cost is going to be low because more people are actually willing to buy or sell the ETF. But when the liquidity is low, that means you have to incur higher transaction costs in order to buy or sell that ETF. Now that you have learned how to analyze the ETF, I want to introduce you a concept of diversification, which is a fundamental concept in the finance. To keep it very simple, diversification means not to keep all your eggs into one basket. So if you keep all your eggs in one basket, what's going to happen? If anything happens, all of them actually going to go break at the same time. But if you keep them in a different basket, the probability of those eggs to survive is going to increase. And that's exactly is basically the idea of diversification in the finance. So in related to the diversification, the first thing I want to discuss is the duplication of the ETF. So what do I mean by ETF duplication? So the ETF duplication means, let's just say when you buy 2 or more ETF and you believe by buying 2 or more ETF you will basically diversifying your risk. But in reality, those ETFs actually hold similar stocks in those ETFs. So what is the ultimate result? Your risk is actually not diversified. Your risk actually has concentrated because there are similar stocks which are in those ETFs that you actually selected to invest. You are basically doubling down on those stocks. So overall risk has actually been concentrated into the similar stocks that are being similar into those ETFs. Now I want to share this concept of duplication by this example. Now when you look at the screen, you will see the two ETFs, the ETF1 and the ETF2. As you can see, both the ETFs are actually hold number of stocks. But when you look at the middle circle, you will see there are number of stocks which are common in both of the ETF. So that means when you buy ETF1 and ETF2 together, you are basically getting exposed to these stocks which are middle in both of the ETF. So this is called duplication, and I will share a detailed case study down the line. When you are looking at the fund duplication, your duplication should be below 30%. If the duplication is 30% or above in the ETF that you are willing to invest, then it is kind of a red flag. And I will share a detailed case study down the line, but before that I want to introduce you another concept which is called correlation. By the name correlation, you can basically guess that means how two things move in relation to one another. And in terms of finance, correlation basically tells us how two ETFs moves in relation to one another. Do they go up or down together, or do they move in opposite direction? You have to realize that most of the ETFs are actually positive correlated. They tend to go up and they tend to go down with the market. But what matters is the degree to which they move. You have to realize to truly diversify, you have to look for the ETF with the low correlation. Now we have a correlation score which ranges from +1 to the -1. The +1 is perfect correlation, 0 means no correlation, and negative means negative correlation. Let me give you an example of that. Now when you look at the first graph which says perfect positive correlation, you will notice that ETF1 is moving up, the ETF2 is also moving up. When the ETF1 actually moves down, ETF2 also follows the ETF1 and moves down. And ETF2 is actually kind of moving in the same direction of ETF1. This is called perfect positive correlation, that one ETF is following the direction and almost to the same degree as the other ETF. Now in the other diagram which says no correlation, you will see that ETF1 is moving its own direction while ETF2 is also moving independent direction to the ETF1, and there is no correlation in between them. In the third diagram, you will see that ETF1 is moving up but ETF2 is moving down, and same when ETF1 moves down, ETF2 moves up. This is what we call a perfect negative correlation. Well, this is the extreme case. This is why we are calling it perfect negative correlation, but it could range anywhere. You have to keep this in mind. Let's just say if you buy two ETF which have the perfect negative correlation. The thing is, one ETF is going to move up, but the other one is going to move down, and the vice versa. And you know what's going to happen with your overall portfolio? It's going to stay flat. So you have to avoid this. You have to look for the assets which have a low correlation, but don't go into an assets or ETF which have the perfect negative correlation. Then there's no benefit of investments into an ETF because your overall wealth is not going to increase. Now let me give you a practical example of ETF duplication. So I have basically selected two of the ETF. ETF1 is called VONG, which is Vanguard Russell 1000 Growth ETF, and ETF2 is VUG, which is Vanguard Growth ETF. When I basically analyze these two ETF, I realize there are 134 stocks in both of the ETFs which are common in both of them. And what do I mean by that, and how it's going to impact the ETF? So when we look at the weightage of the ETF, let's just say each of the ETF has the 100% weight. So 85% of these stocks are actually weighed in terms of these two of the ETFs. So what does this mean? It means when you buy two of the ETF, that means almost 85% you are buying the same thing. And if you remember the pro tip, which is don't buy an ETF which has duplication over 30%. And here you can see that these two ETF has 85% duplication. Now I will tell you how it's gonna impact your return profile. The first thing that you will see in this graph is the correlation between VONG and VUG, and we can see that correlation is 0.99, or almost perfect positive correlation of +1. And if you remember, what does this mean? It means they move perfectly in relation to one another in the same direction. As you can see, when the market was going up in 2011, 12, 13, 14, their returns were similar to one another. But look at 2018, when the market actually decreased. Both of them actually decreased almost to the similar magnitude, of around 2%. Same in 2022. Both of them almost declined 30%. And that is what I'm actually trying to tell you, that when the market is going up, it is fine. But when the market actually going down, both of them actually go down to the similar magnitude. And this is the thing which we don't need in our portfolio. Now, I want to show you a true benefit of diversification by looking at another example. So for this example, I basically selected two of the ETF. Number one is VPU, which is Vanguard Utilities ETF, and the other is VUG, which is Vanguard Growth ETF. And you can see there is 0% duplication. There is zero stock that's basically being common in both of the ETF. So what is the impact on the return? Let me tell you. First of all, you will notice that the correlation between both of these ETF, VUG and VPU, is 0.46, which is quite good. Second thing, look at the returns graph, and I want to show you an important thing, which is the red rectangle is basically shows when the VUG declined, and the green rectangle shows when the VUG basically inclined. So look at 2008, the VUG decreased 39%. That's the time of the financial crunch, right? But look at the VPU, that decreased 30%. Quite a big difference. Again, when you look at 2022, VUG decreased 33%, but look at VPU, it actually gained 1%. Again, in 2018, it's again reverse. 3% decrease in VUG, 4% increase in VPU. Now, look at the other way. In 2015, as you can see in the green rectangle, VUG increased 3%, but VPU actually decreased 5%. And then in 2020, VUG increased massively 40%, but on the other hand, VUP actually declined 1%. And the same in 2023, VUG increased again substantially of 47%, and VUP actually declined 7%. Now this is the thing I want to show. When you have a low duplication, you have a low correlation. So when the market is moving up, things are going good. But when the market is going down, and you can see from here, the low correlation and no duplication returns impact, you can see here that returns actually move to one another, in some cases in same direction, but the magnitude is going to be a very much different, or in some cases there's going to be a difference in the direction. One's going to be positive and the other is going to be negative. And this is the kind of a thing that we look for in our portfolio to truly diversify. I believe this must have really helped you understand the concept of duplication and the correlation. Now I want to discuss about what are the mistakes that you basically have to avoid when investing into an ETF. Number one is you have to stop chasing the hottest ETF. You have to realize when you're analyzing the ETF, you have to select the ETF that suits your need, that suits your investment criteria, your investment goal, your risk and return profile. Don't listen to anyone because everyone has their own unique strategies, their own unique investment style. Second is the fee. As I said before, when you're looking at the ETF, fee is a very important aspect because even a small percentage can become quite a huge when you look at over the horizon of 20-25 years plus. Now, the third thing is the diversification. We have basically discussed this in detail, but again, you have to look to invest into ETFs which basically give you diversification and not concentrate your risk. And the last one is basically when you buy the ETF, you are buying the ETF for the long term. You are not buying the ETF to time the market. So don't do a panic selling. Rather buy the ETF, hold the ETF for the long term so you can see the benefits of compounding. Now that you have learned almost everything about the ETF, it is the time for you to start investing your own ETF investing journey. So what is the first step that you have to do? You have to open up your own brokerage account. It could be opened with the Charles Schwab, with the Fidelity, or even on the Robinhood. The second thing that you have to do, you have to start your own due diligence. You have to do your own research. You have to read. You have to dig up into different fact sheets, and then you have to basically select the ETF that basically fulfilled your investment needs, your investment criteria. And the last thing is start small but stay consistent. No matter what, whether the market is going up or down, market is going boom or bust, you have to invest because you are investing for a long period of time. You have to remember one of a very important concept of investment, which is dollar cost averaging, which is no matter what, you have to invest whether the market is going up, whether the market is going down. You have to invest at a regular interval period of time. It could be after a few weeks, it could be at the end of every month, it could be in the receipt of your salary. You take some amount from your salary or from your other income and you invest regularly into the market. So again, I'm saying you can see the impact of compounding after a few years, and then you realize the true power and true potential of the compounding. I hope this video actually helped you a lot in terms of understanding the ETF. If you like the video, please hit the like and subscribe. If you have any questions that you want to ask, you can ask me in the comment section or you can also email me.